Okay. Yeah. I'll record this and then post it in there. So, um, one of the ways that I look at these ranges, you can even start here this morning. Let's take some of this stuff out. This is old, doesn't matter. So, just referencing just RTH for now, for the sake of for this conversation. So, when we get to 8:30 Eastern time, I measure the first from 7 a.m. to 8:30 gives me a range high and a range low. The first thing I'm looking for is that range high to be violated by a small amount, and I preferably like to see it earlier in the following 90 minutes. So 90 minutes, 90 minutes, 90 minutes. And what I know is like statistically, the first trade outside of this range, if I get some type of short setup, that trade is very high probability that it retests the mid of this range, the mid of the first 90 minutes. So this trade was my first trade of the day, happened before we got started. And it was a short from just up here back down to right here. Once that range high trades, once this plays out once, and we get back above it, I'm not as likely to be looking to fade it anymore, so much as I'm looking for an opportunity to see continuation. A lot of times, when this range is violated, and we trade back to the mid of it, if we can get going below the mid, the probabilities begin to increase that this move down is going to be an outsized move, which means we start to target the low. And if we take the low and then and see no actionable bid back inside, then we look to just stay in the short bias perspective until we engage with the 230 to 7 a.m. Euro range. And that's just the range from 2:30 a.m. to 7 a.m. If this doesn't continue, then that tells us a little bit of information about bias or direction. So I basically monitor for that type of activity like all throughout the day. Those are just spots where I look to have trade opportunities. Now you can go down one more time frame. Say this is 30 minutes of price action, and this is 30 minutes of price action. And you notice here we traded below this 30-minute low, but did not take this 30-minute low. So this would be a spot in theory, if we were on our toes this morning, that we could have been looking for the bears to fail, that they take this low, but they don't quite get to this one. And then the target on this trade is to trade back to the high that brought you down here, which would have been into here. And then you have this short setup because we start a new 90-minute time frame at 10 a.m. And this one is the probabilities from 10 to 11:30 are less likely to pan out than trades that are taken from 8:30 to 10. So your probabilities drop off dramatically during this time frame if you're trading sweep trades. Now this one worked. We swept the high, soaked back in. Your target is the middle of that range, somewhere in here. We've gotten it, but that's not a lot of points, like 20 points, right? But and so on and on I go throughout the chart for the day. So we get to here, the logic for the long is that we traded below the prior 90-minute range with no acceleration. We did that here. I got long somewhere in here. Whatever. We traded back up, scaled some, had some ads, had a runner left, got swept out of the runner here. What's interesting about this is here's the 30-minute swing low that needs to be taken. Hadn't been taken. They ran out of juice. And then if we're back above 19, or sorry, like 16, we're back inside of this 30-minute range. And so we can conceivably look to trade through all of this, these relatively equal highs and this 30-minute high, in theory. So that's the way I look at it, and the logic is that that there's stops just above this, there's probably stops just above this, there's probably stops just below here. We would think that there were stops here that got popped, hence the move back in. And these trades, it's just like I want to be a part of it. I don't know what's going to happen, but I know that it's likely that we at least trade back up to roughly the mid of the prior 90-minute range. And then sometimes that's all we get, and it's a little 15, 20-point trade, and that's fine. Sometimes that is target one, we get target two, and then we start to really see an unwind, and we have maybe added to the position, and so we have a great average that's kind of protected on days where we see a little better movement, and then we're able to be off to the races. I don't like to see us get back in a prior range if I'm long. I would have liked to seen the bulls step up there in this area instead of getting banged back down, and then see that be like the next stair step for a move up. But that didn't happen. But that's some of the logic or some of the ways that I use that to frame up trades. And the why, I guess, the why behind it is just that it seems to work really well. Statistically, I have, really good data on these reversion trades, where they should go to, all that kind of stuff. And which time frames, like the 8 to 10:30 or 8:30 to 10 is a much better time frame to trade this method than this time frame. Or this time frame, really. I think it's this net two more ahead, like in 3 hours or something. That's like the next most profitable over the big backtest sample time to trade it. But it doesn't mean that it can't be traded all the time. It's just when you have a little more edge statistically. So hopefully that's helpful.